Hi traders, you're welcome back to the Forex Geek channel. Now, if you've been trading for a while, you know how important it is to understand how different currency pairs move in relation to each other. Well, in this video, we're just going to be diving deep into currency pair correlations, a key concept that can help take your trading to the next level. Now, whether you are a seasoned trader or just starting out, currency pair correlations will help you make more informed decisions, avoid unnecessary risk, and maximize your trading strategy. So in this video, we're just going to be covering what currency pair correlations are, why they matter, how to use them to your advantage, and we'll even look at some examples of correlated pairs, okay? So if you want to learn how to use this powerful concept in your trading, stay tuned. And don't forget to hit that like button, subscribe to the channel, and turn on the notification bell so you never miss out on more trading tips and strategies. Okay, let us just start with the basics. What exactly are currency pair correlations? Now, in simple terms, currency pair correlations describe the relationship between two or more currency pairs. It's as easy as that, right? Now, these correlations tell us how currency pairs move in relation to one another. They can either move in the same direction or in opposite directions. So there are two types of correlations. Okay, we have the positive correlation, which is when two currency pairs move in the same direction. For example, if one pair goes up, right? For example, if one pair goes up, something like this. If one pair goes up, the other will also go up. Can you see like what we see happening between Euro USD and GBP USD? Then for negative correlation, it is when two currency pairs move in opposite directions. That is, if one pair rises, the other will fall. Right? For example, what we see happening between Euro USD and USD JPY, for example, right? So now, why does this matter to you as a trader? Well, understanding how pairs correlate helps you better anticipate price movements, and more importantly, it allows you to manage risk effectively. Now that we know what currency pair correlations are, let's talk about why they are important for your trading strategy. First and foremost, knowing how pairs move in relation to each other helps you avoid overexposure. Okay, overexposure happens when you trade multiple pairs that are highly correlated. For example, if you are trading Euro USD and GBP USD at the same time, you are basically doubling your risk because these pairs often move in the same direction. So if you understand the correlations between pairs, you can choose your trades more carefully, ensuring that you are not overcommitting to similar positions, okay? This gives you a higher probability of success and helps you manage your risk in your portfolio. Understanding correlations also helps you identify hedging opportunities. By trading pairs that have a negative correlation, you can hedge against potential losses in one pair by gaining in another. This can provide a safety net during volatile market conditions, okay? Now let's talk about how you can identify these correlations in your trading charts. There are several ways to determine whether two currency pairs are positively or negatively correlated. The first is to use correlation tools, okay? Many trading platforms offer built-in correlation tools that show you how pairs have moved in the past. Okay, so you can actually use these tools to visually see which pairs have a strong correlation with each other, okay? Then you can actually do manual chart comparison, which is popular, right? Another way to check correlations is by manually comparing the price charts of different pairs. Just manually look at it. It's very easy. Manually look at it. You're going to see that they're making similar price movement. Look at, we had a downward move and we had a gap down, and we had an upward and we have a down and we have up. Now this is for Euro USD. Now look at GBP USD. You're going to see similar pattern. Can you see? You can see we had an upward move and we had this and we had a gap down and we had an upward move. I have down and we see we are going up now. So you can see that it was similar with the Euro USD. Manual chart comparison. Just look at the charts yourself and you're going to see the similarities. Okay, if you notice that the price of one pair is constantly rising or falling with another pair, they may have a positive correlation. Then you can also use a correlation matrix. A correlation matrix is a table that displays the correlation values between different currency pairs. Okay, so values closer to +1 indicate a positive correlation, strong positive correlation, while values close to -1 indicate a strong negative correlation. Now let's take a look at a couple of examples. Okay, the first example we're going to be looking at is the Euro USD and GBP USD. These two pairs often have a positive correlation. Why? Both the euro and the British pound are heavily influenced by the same factors, such as European economic news or the strength of the US dollar. So if the Euro USD is moving up, it is likely that the GBP USD will also follow in the same direction. So if you are trading one of these pairs, be mindful that taking a position in both could leave you exposed to the same market risk. All right. Now let us also look at GBP USD and let us look at Euro USD and USD CHF. All right. Just have to clear the charts of these indicators, right? So now let's look at Euro USD and USD CHF. All right. Now, Euro USD, this is USD CHF, right? This is USD CHF, and this is Euro USD. So you will notice that both of them have negative correlation. Why? The Swiss franc and the euro are both influenced by global risk sentiment. But when the euro strengthens, the US dollar tends to weaken against the Swiss franc. The Swiss franc is the CHF, all right? And so when the US dollar, when the euro strengthens, the US dollar tends to weaken against the Swiss franc and vice versa. So if you are trading Euro USD, you might want to avoid trading USD CHF at the same time, as they are likely to move in opposite directions, like what we can see happening here. Now that we understand the theory behind currency pair correlations, how can you use this knowledge in your trading strategy? Here are a few tips to help you incorporate currency pair correlations into your trades. The first is to diversify your trades. Avoid trading multiple highly correlated pairs at once. Instead, focus on pairs with low or negative correlation to diversify your portfolio and reduce the risk of overexposure. Secondly, hedge with correlations. Use negatively correlated pairs as a hedge. For example, if you are long on Euro USD, consider taking a short position on USD CHF. Okay? If one position goes against you, the other may offset the loss. Then you can also trade breakouts with confidence. Okay? When you identify a strong trend or breakout in one pair, check for correlations with other pairs. If they also show similar movement, you can trade with more confidence, knowing that the market sentiment is likely widespread. Okay? Then watch for major economic events. Pay close attention to economic reports and news events that affect multiple currencies. Okay? These events can influence the correlations between pairs and create new trading opportunities. And there you have it. That's everything you need to know about currency pair correlations and how to use them in your trading strategy. Understanding these correlations will help you manage risk, diversify your positions, and make more informed decisions. Okay? Let me know in the comments if you've ever used currency pair correlations in your trades and which pairs you think are most correlated. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss any of our trading tips and strategies. Happy trading, and I will see you in the next video.